Hey there, Blockhead Traders. Here, Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of July 28th, 2024. And in this week's episode, it's just myself, Sprocket888, and we are going to take a look into screening for premium. So last week we touched on what exactly is premium selling and what is an option contract and how is all that laid out. And in this week's episode, we are going to touch on what type of things do I look for when I go to try to find premium to go sell. What are the metrics that I'm kind of looking for? How do I know what to sell premium against? Because you just can't grab anything. Not all premiums are the same. There's certain ones that have panned out to be better probability for myself. And it's really, spoiler, overstretched volatility. But before we hop to that, I want to give a shout out to the Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. You'll also find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So find us there, subscribe, and if you can't find us, let us know and we will get it there. So let's hop to this week's content. In this week, we're going to take a step back to say, okay, so you now understand premium selling and what it actually is and where the premium value comes from and how it's priced and what a put is and what a call is. And if all that stuff is a little bit foreign to you, I'll put a link up above to last week's episode where you can hop there, go back, take a look at last week's episode, and then fast forward to here and rejoin us. And I'm going to cover what do I look for when I go to screen the premium. Now, it's true that pretty much all of the underlyings out there have options associated with them. There's certainly premium to be sold. Going by the definition, premium is simply just the volatility and the time to expiration combined are the biggest drivers of that price. And so really, you could sell premium on just anything out there. But one of the things that I have found out is that certain types of premium tend to be a little bit more profitable or lucrative, or a little bit more in your particular favor, in the house's favor, if you would, ever so slightly from their statistical numbers that are out there. And what is this magic that you speak of? And so I've kind of boiled it down into a couple of criteria here. And the first ones that I'm really going to pull up here and we can talk about are, like I mentioned, the two main factors are time and volatility. And so no coincidentally that this is one of the two areas that I've really kind of tried to mess with over the years. And I would say, how far out should you go when selling premium? And to me, it really kind of depends on what you're selling premium against. Most of the time, if you're selling premium in equities, so this is your regular stocks, your Google, your Netflix, your IBM, your Tesla, anything like that, even ETFs, although ETFs really don't have a lot of volatility, so they almost never are good candidates for premium selling. But anything that's kind of traded on the open market, the NASDAQ, the Dow, any of those, New York Stock Exchange, you're going to probably find the best time in the 30 to 45 days to expiration window. You can get smaller than that, which is fine, but typically that's kind of be the sweet spot. Your premium really starts to accelerate, means premium decay really starts to accelerate, and when you get under that 45-day window. And then depending on how far away the money, the closer you get to expiration, the narrower that you can get some of the premium out there for. So I find that 30 to 45 days is kind of the sweet spot where I like to enter, assuming there is no binary event coming up. So if there's a binary event, like an earnings, like a drug release, something like that, you want to try to be cognizant of that and not follow this rule. So a deviation that I make to that is when I sell options on futures. So I tried to start selling options on futures. And by the way, I love doing that. It's one of my favorite products to trade and sell. I started to find that there almost is like this stagnation in premium decay. in that 30 to 45. It never seemed to accelerate as much as it did on the equities. And so I really noticed that in futures options, they start to really pick up their deceleration or decay, time decay, and premium decay around 21 days to expiration. And so I find myself really kind of shifting that range of where I'm trading down closer to expiration when I'm dealing with options on futures contracts. And that's usually in the 14 to 30 day range. Like I said, 21 seems to be the magic spot where it really starts to pick up decay. So that covers the time factor. But what about the volatility factor? What are you looking at from volatility? And so where you want to go is volatility is really an oscillating signal. Your volatility, you get more volatile, you get less volatile. You get more volatile, you get less volatile. And so a lot of your volatility charts are going to kind of look like a sine wave, or at least oscillate around a median. And what I find is better is because we are selling the premium, we want the premium to decay. We want that premium of volatility to go down because volatility is going down. And so I find that the most probabilistic time for volatility to contract is when it's at the peak or the upper end of that oscillation. Now, it's not a guarantee that if you have extended volatility that it's going to come down anytime soon. That's not true, because you can find periods of extended volatility where stocks just stay uber extended in volatility for a long, long time. But in general, when they reach that higher volatility, they'll start to come down in volatility. And when it comes down in volatility, price comes down. And because we are shorting the premium, that means more money in our pocket because we can buy back to close much sooner. And what are the magic numbers that I look for here? So I always look for volatility not as an absolute number, because you will get certain stocks like staples and consumer staples and things that are kind of tried and true blue chip type companies are not so volatile. So their absolute number might be relatively and significantly lower than a tech company, a pharmaceutical company, a growth company, where that volatility is going to be much, much higher on an absolute basis. And it's not so much the absolute number that matters the most to know if something is overextended, but rather the historical ratio of where is it relative to the historical volatility levels. So for example, something like a Campbell's soup might normally have a volatility of around 20%, maybe 25%. So if you get a 35% in Campbell's soup, that's going to be an overextension of its historical volatility. You'll be in a higher percentile. You might even be in a 100 percentile of its range over the past year, because that's very volatile for that type of stock. However, if you look at a 30% volatility in Netflix, that is incredibly quiet and non-volatile. Netflix is typically regularly up in the 80s and 90s% spot volatility. And so it's all relative to itself. And that's what that historical above 50% is. It means you really want to try to screen this for IV percentile or IV rank in above the median, and the median being 50%. Now, once you start looking at stocks that are in the 80% historical volatility, 90% historical volatility, that's when you can bring in where is the spot volatility, because that's going to be your next factor in how much premium you can find. So let's say you've got Campbell's soup at a 90 percentile historical volatility, and let's say you got Netflix at 90% historical volatility. So all things equal, you're looking at both of these and you can only play one. I would say you look at the absolute volatility price, or the absolute volatility number. So Campbell's soup might be 35%, like I said, and maybe Netflix is actually at 99 or 120% or 150%. So that absolute number is going to be higher. Now, they're just as extended relative to themselves. So the amount of contraction that we can expect or probabilistically assume is going to be the same between both of them. But the net premium value that you're going to collect is going to be significantly higher on that Netflix because its spot volatility is greater than the spot volatility of Campbell's soup. So I mentioned in there, assuming that there is not a binary event coming up. And this is where I want to get into two different criteria that I trade, or when I go for screening. The first screening is my general screener. So this is, okay, if I don't really want to play a binary event, if I'm not playing earnings, what am I looking at? The screener after this I'll touch on is going to be earnings. And I'm going to talk you through this here. And then after I talk through both of these examples, I'm going to bring up a live screener and we're going to just take a look at the results and I'll talk you through some of the live results that come back. So what is my general screener? So like I mentioned previously, I'm going to look in that 30 to 45 days to expiration, which you don't really put in your screener. You do that when you're looking at the option chain. But I'm going to look for that extended volatility is really what I want to see in here. And the way that I do that is the first thing I do is I say, I don't want to look at any stock under $15. That's just something my threshold is if the stock price is below $1,500, the amount of premium that happens to be associated with that is too small for me to really want to take any sort of risk or put a lot of contracts out because in order to get appreciable gains there, you're going to put a lot of contracts and you're going to pay a fee and a commission to every contract that you open. So the less contracts I can trade and get to the profit targets that I want or the buying power and position sizing that I want, the better. So I would rather trade, 1 or 2 contracts of a higher number underlying versus, 10 or 15 contracts of something like $15 or less. So right out of the gate, I say, if you're trading lower than $15, I don't want to see you. That also helps weed out a lot of penny stocks, dollar stocks, things like that can be incredibly volatile and send you false signals. Because what I'm looking for here is pretty solid traders that have the volatility. And that's really where some of the next numbers come in. Well, before we get to that, the spot volatility, I want to be at least 30%. Now, this is not the historical volatility. This is the actual spot volatility. And what I found is pretty much anything under 30% spot volatility just isn't exciting and just isn't worth it for me. So I want to make sure that spot volatility is at least 30%. Now, that generally pushes me more towards growth stocks, active stocks, stuff like that. Keeps you out of the real laggards and just kind of duds that don't go anywhere. But that kind of is something that I throw in there. So now back to kind of weeding out the noise because there's tens of thousands of stocks out there that are just noise. And that's where I put in market cap. So I don't want to touch anything that's got a tiny market cap. And so this I can tweak a little bit, but I've typically kind of start at $300 million market cap. If your company doesn't have $300 million worth of market capitalization, I don't even want to look at the option chain. It's not worth my time. So your spreads are poor, the volume's not there. It's just not worth it. So you can kind of tweak this to see where it fits for you. For me, that 300 million is usually where I start. And if I get too many names I've never heard of or the spreads are too poor, I'll pull up that number and look for higher market capitalization. Now, the last factor that I put in the screener is the amount of volume. So volume is liquidity. Liquidity is king. So we want to be super liquid because that's when you're going to get your fair market fills. That's when you're going to be able to trade in and out of this thing. That's when you're not going to get, a bad fill on a wide spread. So we want high volume. And this is another area that I'll tweak quite a bit, but I have had pretty good success around the 1 million share mark. And you want to be careful. You want to make sure that you extend this range of your average over a long period of time because, you can get a hot stock that had a big news day and they'll trade over 1 million shares. Maybe they'll trade 10 million shares, but maybe the rest of that month they're, pumping maybe 100,000 shares a day. So that's not going to be a high volume stock. And so this is where we want to go over a 30-day period. We want to see an average daily volume of about 1 million shares a day. And that's going to be pretty consistent on a high volume, high liquid name. And you can tweak this number. You can look at the scan results and see, where it fits you. This is another tweakable number. And then the last thing that I do, and this is not in the screener, but when you look at the results, is I sort them by IV percentile. So that goes back to that extended volatility. The IV percentile is a value that is associated with the underlying, and it tells you relative to the past 52 weeks of trading, where does the volatility sit now relative to itself? And so this is where I'm looking for a number of at least 50%, and I'm going to sort it on descending order. So I'm going to get the highest historical volatilities first, and those are going to be my preferential things to trade. And I'll pull that up after I talk you through the next slide of what it look for in a binary event or an earnings event. So binary event, earnings event, that's something that earnings are a binary event. Binary event is something where everybody knows that it's coming and the outcome of that one day is going to alleviate a lot of uncertainty. So a lot of times this is going to be a announcement of an FDA test result trial. The biggest one that every company goes through is an earnings announcement. So leading up to every earnings announcement is usually a very volatile, very uncertain time, and you will see volatility creep up, creep up, creep up, creep up. You'll hit earnings, the earnings announcement will be out. That's the binary event. And after the binary event, a lot of the uncertainty goes away and that volatility will contract and drop. So what does my screener look like when it comes to these earning type events? And honestly, it looks really almost the same as what I just ran through, except I put a few little tweaks in there. Again, I'm looking at only underlyings that are at least $15. I want the volatility to at least be 30%. That's the spot volatility. I want the market cap to be at least 300 million, average daily volume of at least 1 million shares. Now, in here, I might reduce the time. So here I have this average daily volume over a period of just 5 days. Now, the reason I have that over 5 days is because I'm looking for a binary event that's going to be right around the corner. And I'm not looking for that longer term, how tradable is this? I want to know how tradable is this right here, right now, in this moment. And that's where I narrow that down. And if you want to stretch it back out, you can go for it. But then the very last one, and this is what I add, is you can put in your screener has an earnings event coming up, and you can tweak this number. So you can do an earnings announcement greater than 3 days, but less than 5, and target that range. You can say greater than 0, but less than 3 if you want to get earnings announcement, in the next 3 days. And this is really where I tweak to try to get this list to show me just the immediate earnings that are coming up. Now, a lot of times what I do is I will look this up for the next 5 days, and I'll try to look on a weekend, a Friday night, a Saturday night, a Sunday night, to try to see what earnings are coming up in the upcoming week and where do the shares sit at the start of the week. And then what I'll do is I'll just make a little cheat sheet for myself, and I'll say, look at on Monday, look at this company. On Tuesday, look at this company. On Wednesday, so depending on when their announcements are, I kind of plot out my week on when I might want to try to trade one of these things based on when their earnings announcement are. The goal here is to put the trade on and the last trading day before the earnings announcement. So you have to pay attention to before the bell or after the bell. Because if the earnings are before the bell, that means you need to have the trade on the day before earnings. If the trade is after the bell, you can put the trade on that trading day because the earnings will come out after the close of the market. Remember, you cannot trade options while the market is closed. They can only be traded during regular market hours. There is no such thing as after hours option trading. So let's go ahead and put some of this stuff into practice and take a look on a real live session here. Now, technically the market is closed as I'm recording this. However, we can go ahead and see a lot of these numbers and what they're going to look like by looking at them. So I pulled up here, the screener that I actually have up here is my general earnings screener. So I keep these, I save these off filters. So this is my core option base. So this is my close above 15, 30%, market cap 30. And I have basically run scan. It's going to go ahead and look for 1,000 stocks. Didn't return 1,000, basically a good chunk, maybe 545 show up, and they're all listed right here. So what I'm going to do is you can see right here is my column of IV percentile. And this is going to show me, where do these things stand relative to themselves. And one of the first things I'll generally do is I'll skip all this NAN. They're not going to have a full year's trading history to kind of come up with a real percentile. And so a lot of times I'll look over these. Sometimes if a name catches my eye, like, oh, I've heard of this one, or I know this is something that just came out and started trading and is in the meme stock land, like Rivian. When Rivian came out, Rivian was something I would look at up in here because there was lots of volume traded. It was hot. There was lots of action. So I would look at that stuff for a short-term trade. But generally, I'll skip over all these NANs. And I'll start looking down here at 100%. And this is where I'll give my preferential of where I want to look first. So you can see right off of here, Chipotle. This is something that it's at 100% volatility, historical volatility, which means it's been as high as it ever has been when it comes to premium. And so this is 100% a trade that I probably would look into a little bit more. And this is where I say the spot volatility. So the next column over, implied volatility. This is where you can say, okay, Chipotle, Celsius, Schlumberger, Unity, all these are equal because they're all 100. So if I'm going to trade these, where do I make a differentiation? And the next differentiation is either going to be the next column over, this is your spot volatility, or maybe one more column over, which is going to be your volume for the day. So you can see right here, Chipotle trades 15 million shares today. Okay, that's pretty good. The spot volatility is about 50%, 49.36. But I might actually come down here to Unity and look at that Unity. Unity is also at the same extended percentile, but it's almost double the percentage of Chipotle. So it's trading at 94.63 spot volatility. Also, this is trading at a much lower price. So depending on the position sizing and stuff like that, right? Chipotle is trading at $56, whereas down here on Unity, we're trading at about $17. So your position sizing, maybe $56 is too big for your position sizing, and you have to come down here to $16.93. The other thing is maybe they're both okay, and $16.93 is going to give you a higher spot volatility, so you're probably going to get more premium in there. So let's go ahead and we're going to take a look and dive into each of these to see, okay, what does this get me? So let's start with Chipotle, and we will go ahead and send Chipotle over to the option chain, and let's go ahead and take a look at the Chipotle option chain. So let's go with 1 month out, 32 days to expiration, and let's come down here and see how much premium do we get for, let's say, a 20 delta. So right here, we got a 20 delta, which is probably going to pull in about 90 cents in premium. So we're going to be out there at the 51 strike collecting 90 cents of premium on a 20 delta. If we switch that over and let's go ahead and take a look at the Unity, which remember is double the volatility. Let's also stick with the same expiration and let's try to take a look at the 20 delta. Right here, 20 delta, okay, it's an 18. Chipotle was 19, but we're looking at about probably 48 cents premium. So right there, we're going to collect more premium on the Chipotle, but that is only because Chipotle is a bigger underlying. If we look at the percentage of the strike, so here we're at a strike of a $14 strike. And so if you want to look at the premium relative to that $14 strike, we're going to collect about 48 cents of premium on a $14 strike. It's about 3.4%. And if we go ahead and look at the Chipotle, which was, so if we look at the Chipotle, which was about a 90 cent premium on a 51 strike, that's going to be about a 1.7%. So right there, what I'm talking about. Your ratio, your percentage, your return on capital is going to be greater with that higher spot volatility that is in the Unity stock. Even though the net premium value is a little bit less here at like 48 relative to where your strike is, where the buying power consumption is going to be, that's going to be your higher number as far as collecting premium. And that's why that volatility. So here, this, 32 days out is at 92.97%. And that makes a difference. So how does all this change for earnings? Well, let's go back to the screener here and let's go up and let's go ahead and go to my screening query and let's go ahead and pull my pre-filter here for basically earnings plays that are coming up. So again, we got, this is a little bit modified. This is going down to $10. You can tweak that, I guess. 30% spot volatility. Here I can screen out my IV percentile. So sometimes I do this, but I find just sorting in reverse descending order is good enough, so I leave this range wide open. Here is where I'm going to say, hey, who's got earnings in the next 8 days? Let's say I only care about the next 5 days. We want a period of 5 of $1 million and also has earnings. So this is a duplicate because I want to get it in the next 5, but I could delete this last one, or if I wanted to give a range, I can use this other one to shift has or has not in there. So let's go ahead and scan this. And then this is going to tell me that we have about 30 stocks that fit my criteria that have earnings in the next 5 days. And I've got them sorted on reverse IV percentile. Right here, we got Schlumberger. Remember, Schlumberger showed up in my other filter as well, but it also means that they have earnings coming up. These will have the earnings announcement. So this is actually on July 19th. That's this Friday before the bell. So that's something that I might want to trade. We got great volume, great implied, great spot volatility, overextended. And this is exactly what I look at when I go to make my trades. Progressive Audio or Progressive Insurance here, Progressive Company of Ohio. They have earnings on 7/16 before the bell. That means on July 15th, I have to have this trade on. Otherwise, I won't be able to sell that premium before that binary event happens and occurs. And this is exactly how I screen. And every broker out there is going to have some sort of form screening to this similar metrics like that. And that really narrows it down because now, for example, if I'm playing earnings, I only got to look at 30 trades. And as I get down here on this list, you can see that 50 drops off right here, probably about halfway down the list. So half the list I'm not even going to look at because their historical volatility is not in that overextended state. And that is a key thing to make sure that you get, because if you're not overextended, the chances that the volatility is just going to continue to rise is higher because there's still maybe volatility that's gotten sucked out of it that hasn't made its way back in. It is an oscillating metric volatility. And that brings us to the end of this week's episode. Just a little bit of a dive on how do I actually screen for volatility? What are the metrics that I'm looking for? How do I narrow down the tens of thousands of stocks that are out there to zero in on the types of trades that I want to take? It's really centered around looking for that extended volatility. When you find that, you want to make sure that you then take preference over what is the most extended, then take a click down from that and say, where's the spot volatility? Because if you have two things that are both overextended equally, the preference should probably go to the one that has the higher spot volatility, as they're going to have more premium on a dollar basis built into the underlying. And this really should help you narrow down the field and figure out where to focus your efforts, where to dive into them a little bit more. Now, I didn't talk in this episode about looking at the charts, looking historically, how does volatility contract? Maybe we'll save that for a future episode if that's something that you want me to kind of dive into. That's the next click down as far as looking at a particular trade to know where is it sitting price action wise, where is it traded historically. You know, history never repeats itself, but it often rhymes. So, you know, that's just kind of the next evolution of that. First thing is to understand what's a premium, what's a put, what's a call. Next one is, okay, I got all that. Where do I go look? How do I narrow this down? There's just too many choices out there. Show me a shorter list. And that's really what the screener is aimed to do, is dial in to that smaller subset of things that hit your criteria that you're out there to trade. So hopefully you found this somewhat enlightening. If there's a particular thing you want to hear about, drop me a note in the comments, Blockhead Traders, and let me know, and we'll be sure to put it on here. Otherwise, good luck out there. I hope you're finding trade that interesting and making you profit. Good luck, and remember, think outside the block.